Well, Victor, it's been a crazy few days in the markets. And for the first time in a good long while, people really care about macroeconomics and our geopolitical situation. So today we're going to walk through what's happened with the tariff conversation, where we are, where we're going, and all the craziness that's come along the way.
Yeah, it's definitely been a wild few days. We're recording just a few days, almost a week after Trump's reciprocal tariff announcement, and that really took markets by storm. I mean, we saw over the course of the following 2 days after that announcement a $5 trillion market cap drop across the equity landscape, and I mean that is just one of the biggest moves we've ever seen in market history. And that's because the market was expecting this reciprocal tariff situation, a tit for tat kind of environment. And what was actually implemented was far different from that. I want to get into that here in a second, but it's just really understanding the scope of this and how much it impacts markets is so significant. We have spent weeks at this point heading up into this with several recordings talking about the Trump administration, about tariff implementation, and we finally saw what was really kind of the culmination of at least that initial push, that initial proposal for tariffs. And it was just worse than what Wall Street expected. And so we saw that market reaction, and we've had some serious choppiness over the last few days.
And that drawdown was made even worse because the couple of days leading up to this announcement, the markets were not excited is the wrong word, but they were really anticipating a less than situation where, tariffs come out, they're very minor, things we can work through pretty easily with our trading partners. We did not get that. We got the opposite of that, where he starts off very strong on a lot of these countries. And I'll just get into it. What what he actually didn't announce is first a 10% baseline tariff across all countries, and that's just kind of irrespective of what the trade balance looks like, what their tariffs look like. Even notably, certain countries that dropped their tariffs to zero before this announcement, kind of in hopes that they would get spared from any reciprocal action. 10% on everybody, and then you had the reciprocal component on top of that being it's what really turned into a trade balance conversation. We'll talk about how this calculation was made later, but, and this is ranging from, 11% to 50% and more for certain countries that are just very heavily skewed trade balances from us.
Yeah, I think this was interesting because it was all put in place. We had already seen the tariffs on Mexico and Canada of, that 25% roughly. And with the exclusion of the USMCA compliant goods, now that has stayed in place, and Canada and Mexico did not get hit with any additional reciprocal tariffs. So I think, the market can kind of view that as a positive. I think most analysts and market participants were kind of hoping that we'd get to your kind of end game agreement with Mexico and Canada before these reciprocal tariffs hit. Those are still probably the two countries that are going to be earlier in the cycle as far as some kind of negotiation goes. But what we've seen over the last, few weeks is that while Mexico's been kind of, really working the negotiations with the United States, Canada has been distancing itself by some extent, which is going to be interesting as far as those are still our two biggest trading partners. So getting a solid agreement in with them will be really important. And I think everyone would like to see some kind of renegotiation of the USMCA agreement, just because we really want to have free trade with those two countries. But to your point, the magnitude of some of the tariffs that were implemented, on those other countries was really substantial. And it has serious implications for global trade. Now, I will make the note that there's some really interesting exclusions, and this is where you get into this, kind of uncertainty. The whole market, really part of that big drop is the uncertainty associated with these tariffs. How much of it's negotiation? How much is actually going to stay in place? And I think part of the Trump administration's, to some extent, being careful with this, because there's some really notable exclusions from these reciprocal tariffs. copper, pharmaceuticals, semiconductors, lumber, critical minerals, and energy were all really excluded from that reciprocal portion of it. And those are really our most important inputs into the production process, especially critical things within the United States. So you are kind of leaving a lot of that untouched. But of course, a lot of your consumer discretionary, consumer staples, things that we source cheaply from other countries, those were really impacted. So I'd kind of love if you would go through how this calculation was made, how these, quote unquote, reciprocal tariffs actually got placed and what made up that number exactly.
Yeah, and I think this is a very important part because when we were hearing reciprocal, all of the conversations revolved around, okay, what tariffs do they have on us? That's kind of more or less what we're going to put on them. That was the idea that everyone was working with. And the math that came out of it was very different than what anyone was expecting, which, probably drove a lot of that market downturn that we saw because it was just so unexpected. So what it actually was entirely based off of our trade deficits. So the US has been running a very large trade deficit with the rest of the world for a very long time now. We're a very services oriented economy. We have high tech firms. We have the largest capital markets in the world. None of those services get captured when we sell them to other countries. Someone in Europe logs into their Netflix account, that doesn't count as an export. So a lot of what we supply the world doesn't show up on this trade balance. And so this is all focused on goods. And so because we're one of the largest and richest countries in the world, we buy a lot of things. And so, large trade deficits import way more than we export. And so the administration has viewed this as a problem and decided that the reciprocal tariffs will be based off the trade deficit. So just taking an example, if we trading with, country X, column, and we buy $1,000 worth of their goods, they buy $200 worth of ours. You're just taking that difference, that $800 trade deficit we have to country X, dividing it by the $1,200 total trade and getting a 75% reciprocal tariff. Now, the administration did take that 75% number and cut it in half, citing that they're being very kind to these countries. But all it is essentially half of our trade deficit is what got instituted as a reciprocal tariff.
Yeah, I mean, Hunter, you make an excellent point talking about the things that aren't captured in a trade deficit. And I think this is extremely important to think about when you're talking about the United States, because what we are really exporting to the rest of the world isn't in the form of goods necessarily. I mean, it's important to note that we're about 3% of the world's population, but we make up a quarter of the world economy and over 50% of the world's capital markets. So when you're talking about the way that we export software, the way that we export, financial products, financial markets, that doesn't get captured in a traditional trade deficit because they're not physical goods that are changing hands and it's not easy to track. But via a lot of those services, we are exporting a lot to the rest of the world. And then getting back to your calculation, I mean, because this is based off of the trade deficit, we saw that Vietnam was, according to the administration, implementing a 90% tariff on us. Well, that was really a 90% trade deficit, which meant we were going to institute a 46% reciprocal tariff on them. Well, the fact of the matter is that, Vietnam is never going to be able to afford as much in goods from the United States as we will be able to afford from them. We're a much richer country. If you look at it on a per capita basis, our population is far wealthier than the Vietnamese. And that's why so much of those kind of base consumer items started getting produced in Vietnam as suppliers really moved production out of China and into countries in Southeast Asia like Vietnam. You have them producing a lot of sneakers, a lot of clothing. And so that gets shipped to the United States and we can afford it because we are a very wealthy country. And that's why I think the market was so taken aback by this and confused about the reciprocality of it, because fundamentally we need those trading partners. I like to use the metaphor and the example of if there's a village and then there's a doctor and a clothing tailor. Well, if the doctor is going to the tailor every, once a month, getting a new suit made or a new jacket tailored or pants hemmed, and then the tailor comes to the doctor once over the course of the year to get his annual physical, and then they look at the end of the year and the doctor says, I spent so much more money with you over the course of the year than you spent with me. That's not fair. I don't like that. And so now I'm going to charge you a lot more if you're going to use my services so that we have an equal relationship. Well, I mean, the doctor did get a lot of services out of the tailor over the course of the year. And because he maybe was wealthier than the tailor, ended up spending more money with that individual. So it's kind of like the way that it is with the United States and smaller countries like Vietnam. And I think that's why the market feels like these tariffs really can't stay in place for an extended period of time, because it's just not going to work on kind of a supply chain and fundamental level.
And coming off of that, there's been kind of this back and forth. Oh, tariffs are here to stay. Oh, they're just a negotiating tactic. While I think in this case, as with a lot of things, the truth is somewhere in the middle. I think the administration really does want to drive some tax dollars and address some real legitimate imbalances in trade and just trade regulations. But I think it's a great opportunity, and we're already seeing that's a great opportunity to bring trade barriers down, actually. And, as, an investor, as a economist, I love to see, free trade. It's especially with our peers, our allies, it's a wonderful thing. And we've already seen a number of countries come out with a 0 for 0 proposal, saying that they'll take their tariffs to 0 if we take ours to 0. And that just creates a great environment to, form these new trading relationships as the administration wants kind of hit the reset button on a lot of these things. One big consideration with this, though, and we've seen the administration be very slow to agree to any of this as of recording. There haven't been any major updates to the tariff situation. There have been a lot of talks, but no one has signed a formal agreement to do a 0 for 0 at this point. And I think one of the big hangups is those non-tariff barriers. You'll see the administration cite that tax. That's not really applicable, but there are many things that are applicable. The EU has a digital services tax that was made to target our tech companies specifically, because the way it's structured, the way it's written, and kind of the balance of the trade between the countries or the country bloc is it was written to attack American companies. So seeing stuff like that, those non-tariff barriers get reduced, is also very important to getting those 0 for 0 propositions through.
Definitely. And I think the earlier that the administration can get these negotiations completed, the faster you're going to save frankly, the global economy, but especially the US economy, from economic damage. Because as we're kind of talking about, these tariffs aren't really that tenable for a long period. I mean, if the reciprocal tariffs go in place and they're set to do that April 9th, then it'll be interesting to see how long they're actually in place, because it is going to create some economic damage. I mean, the thing is, companies can't relocate all their supply chains to the United States overnight. This is something that's going to take years. And even if permitting gets expedited and things like that, companies are still going to be hesitant to make that investment, because it is going to be a lot more expensive to create a lot of these products within the United States. I mean, you don't have a lot of Americans ready to line up to go work in a factory making sneakers, for $10 a day or something like that. And that's just the unfortunate reality of it, whether it's, fair to people, in Southeast Asian countries or not. That's just the way that the global supply chain is set up right now. And markets are relatively efficient. So companies are going to find the cheapest source of labor and whatever makes the most sense for their bottom line. And it's going to take some time for that to eventually relocate to the United States. And so that kind of gets me to what some of the economic implications of the tariffs are. Now, have to kind of talk about it as if these get implemented, because that's just that's the base case that we're kind of operating from right now. I think you and I both believe that these will be negotiated down, but if they are to stay in place, I mean, the most obvious economic impact is through increased prices. A lot of companies will try to maybe take a hit to their margins, keep prices, lower for an extended period of time, maybe eat some of the tariff, maybe the producer of the good, eats part of the tariff cost. But at the end of the day, a lot of that's going to have to get passed through to the consumer. So if you have a 40% tariff, maybe between the company and the producer, they're able to take on maybe 20% of that, but the consumer is going to have to take the rest until supply chains can shift. So that's a pretty obvious one. And I think we're already going to see the impact of that to some extent over the coming months as inventories start to run low and companies are kind of grappling with what to do in this next stage of the tariff situation.
Well, and that's a great lead into the next point of, supply chains moving around the world. That doesn't happen overnight. And part of that issue is that whenever there's so much uncertainty, and even if the administration comes out and, with whatever the final end game is, says, cross my heart, this is the last change, businesses are still going to be slow to, onshore a lot of these supply chains, reshore them to places with lower tariffs, just because at the end of the day, Trump has almost 4 more years here. So by the time companies shift production to the US, that could take 2-3 years, depending on what product they're making, where their supply chains are located. This is a multi-year investment. And by the time they're done making that investment, we'll likely have a new administration, or we will, because it's Trump's second term, so he can't run again. So looking at, just from that perspective, people are hesitant to make large moves and large new investments. And then even those that aren't directly hit by tariffs, you're looking at a drought in M&A deals because there's just so much uncertainty out there. In general, just even if you're not related to tariffs, you're kind of pulling back and not spending a whole bunch of money right now on acquisitions, on product, on expansions. And so the whole economy is contracting due to that. And, we are seeing a real reduction in growth and in GDP.
Yeah, we've already seen companies step back from deal making to a large extent. I mean, it's going to slow down merger and acquisition activity. I think a lot of the financials companies who support that and private equity companies are a little bit stressed right now because they are seeing a big slowdown in deal making and business activity. So whether it's banks doing the lending or companies facilitating that merger acquisition, there's a lot of companies who are stepping back saying, hey, we don't know what the environment's going to look like, so we're going to take our time here. And so that's already working its way through the system before these tariffs have even really fully been enacted. And then the final point I want to make as far as kind of economic impact is dollar devaluation. So I think the interesting part, and this is going to have long-term implications, I think, as far as how we interact with the rest of the world as the United States, is what is the foreign demand for US dollars? Well, if the US is a very, very large trading partner, you're going to have a high demand for US dollars, and that's going to increase the value of US currency, of the US dollar. And so if you see foreign countries, foreign investors kind of step back from investing, in the US or doing a lot of business with US capital markets, that could lead to dollar devaluation. Now, kind of the irony of that is that if the dollar is cheaper, then it makes it, less expensive for other countries to purchase our goods. There have been a lot of gripes with China over a long history of time of them intentionally keeping their currency, devalued, and so that their goods look more relatively attractive. But that could actually be an impact from this. Now, it's good to have a reasonably strong currency, but the US doesn't want to see their currency weaken too much. We're still the global reserve currency, and we don't want to lose our status there. I don't think that's necessarily a risk, but if you separate yourself too much from the rest of the world stage, that is something that's going to have an impact. So it's going to be interesting to watch. And so we'll just have to keep tabs on that one.
It is absolutely a huge concern. It's one of those, like you said, low probability things, but high cost if it was to come to fruition, just because, so many foreign countries holding our currency and our treasuries and all of that is a huge effect. If they start selling that, then that's going to have incredible ramifications. That would be a slow process. It wouldn't be a quick moving thing by any means, but certainly something that people have been keeping an eye on over the last few years, just because of the implications if it were to occur. Which, kind of leads me into the challenges to this. Donald Trump has taken very kind of unilateral power in instituting tariffs just across the board. And it's kind of gotten me personally curious as to who really holds the power to do this. Does Donald Trump really have the power to follow through on all of this? And it turns out it's really more of an emergency power for the president. The right to institute and remove tariffs still, sits with the Congress. So they're the ones who really make the decision at the end of the day. And they can vote that what Donald Trump's doing is, not just vote to not allow him to continue doing what he's doing. However, with a Republican majority, and they would need a veto proof majority to get anything through Congress, it's not looking like there's a real chance that Donald Trump faces any pushback, at least from the congressional side.
Yeah, I think you would have to see the situation get much more untenable. And the thing is, I think if the economy really started looking like it was a really tough spot, then the Trump administration would do something to shift it, whether that's renegotiate tariff agreements or something to where it didn't take an act of Congress necessarily, because that would be a process. If congressional members said, hey, so many of my constituents are in really tough economic times, we need to put a bill forward that removes this tariff power, then things have already gotten pretty bad, because like you said, with a Republican majority, it's looking unlikely that you would get to that point, at least anytime soon. Now, I think what's probably a more realistic scenario, or more likely, is that the Supreme Court says that this most recent wave of reciprocal tariffs was unconstitutional, because there has to be some kind of economic or countrywide emergency associated in order to enact tariffs in this way. I think it'd be kind of hard to argue that there was a pressing emergency for these tariffs. Now, the Supreme Court probably doesn't want to conflict with the president in this way, but I think you could potentially see that being something that they push back against. Again, there's some social pressure involved. There's some political pressure. Of course, the judiciary is supposed to stay out of that. So it creates a really interesting dynamic and kind of puts them in a tough political situation when they really want to act outside of that. But I think that's probably the more likely of those two scenarios if we were to see these tariffs pulled back by somebody besides the administration.
And so, assuming no one steps in to do anything about this, the Congress or the judiciary, where do we go from here? We kind of talked about it earlier. We touched on it, that we don't expect to stay at these huge levels of tariffs across the entire world forever. At least not for very long, in my opinion. But I don't think we're going straight back down to zero tariffs. It's kind of the between negotiating power or actual taxation. I think the answer lies somewhere in between. Our base case is that these get negotiated down. The question remains is how far. Personally, I'd love to see some of these 0 for 0 agreements go into effect. At least with, the more friendly countries, the ones that are close trading partners, the ones that don't really have large barriers acting against us or, either way, really. But, that's something that we'll be looking for, and I think the whole market's looking for, see what progress we actually make on these negotiations.
Yeah, I think that's going to be interesting to see whether the administration takes the wins that are on the table, because luckily the movement in recent days has been for other countries to move to that 0 tariff environment rather than institute further tariffs of their own. So actually we've moved in the right direction. The administration can go ahead and take those wins, say free trade, this is great, you're our best trading partners, let's go to zero tariffs, and boom, you've got a great situation out of what was really sticky and probably a bad initial proposal and implementation. You could actually get something very beneficial out of that. Like we said, the question is how much are they going to be hung up on the deficit piece of this versus the actual trade barriers and tariffs. And the thing is, the quicker, I mean, I'll keep harping on this, but the quicker that we can get these negotiations in place, go to a more free trade environment, which the whole world really wants to see, the faster we can get back to some good fundamental economic data. I mean, we saw last Friday that the jobs market is still very strong. Things look healthy in the economy. We kind of had some slowing growth heading into this, but things still look pretty positive. So if we can get this tariff situation out of the way, get businesses back to normal activity, we could have pretty good financial markets and just a strong economy in general. Avoid the pain. Everybody stays pretty happy. And I think that there could be, wins all around for the administration and business folks as well.
Yeah, I certainly agree with all of that. But I think one thing that we could address, because I've been seeing it all over social media, the president himself retweeted this about, intentionally tanking the markets in order to get the Fed to cut rates. I don't want to harp on this for too long, but just looking at it from, an economics perspective, that would be a poor move, because yes, it'd be great to have low interest rates for housing prices, for the country's debt. However, it's injecting a lot of uncertainty, especially around inflation, back into the conversation. And the Fed and Jerome Powell are not going to cut rates if there's uncertainty, particularly around the future of inflation. So this is not, I don't personally see this as a very efficient or effective way to go about that. Really, your best bet is just give him another year to focus on, doing what you can in the meantime, and then refinance the debt once we're, a percent lower Fed funds rate, or, however low we get under Donald Trump's administration.
Right. Well, this is definitely going to be an evolving topic, and this is going to be shifting significantly over time. So I almost guarantee this will not be our last podcast on tariffs. But I think we did a good job of breaking it down today, and hopefully our listeners got something out of this. Hunter, thanks for joining me on the podcast.
Yeah, thanks, Victor.